Welcome to the Tech Index AI podcast, where we blend tech IP data, reports, and charts with the latest news in all things logistics with a focus on air cargo. Today, we're taking a deep dive into the current pulse of the air cargo market, looking at its impact on global logistics and, well, the wider economy, too.
Yeah, exactly. We're trying to connect the dots for you. Yeah, linking the latest air freight rates, what's happening with oil prices, always volatile, and those really crucial shifts in capacity, both for air and sea containers, too. The goal is to figure out what these trends really mean for you.
Okay, great. So let's start with the data, the tech index itself. It's the benchmark, right? The overall index, the BAI 0 nudged up a bit last week, about plus 2.6%.
That's right, plus 2.6% week over week, but, and this is important, it's still down over the year, about minus 5.9% compared to 12 months ago.
So a mixed signal there. But you mentioned regional differences being key. What are we seeing?
We really are. I mean, and this is where it's interesting. It's not one single story. Look at China rates out of there to Europe to the U.S., even these newer lanes into Mexico. They were all up. Shanghai, the BAI 80 index, that jumped plus 3.6% in just the week. Hong Kong, BAI 30, also up plus 1.4%.
Okay, so strength out of Asia. But Europe, you said that was more complicated.
Yeah, Europe's a real mix. London Heathrow, the BAI 40, it actually surged, up plus 11.6% week over week. That pushes its gain over the whole year to plus 18.3%. Pretty strong.
Yeah, okay.
But then you look at Frankfurt, BAI 20, and it fell negative 6.6% in the same week. Big difference.
That is a big difference. London booming, Frankfurt dipping. Any thoughts on why? Different goods, maybe? Supply chain adjustments?
Could be any number of things, honestly. Maybe London seeing more high-value stuff, electronics, pharma, perhaps diverting from sea freight issues or specific product launches. Frankfurt's dip, well, maybe that reflects a bit of a slowdown in, say, automotive parts, which rely heavily on that hub. It really shows you need to look lane by lane.
Right, it's not just one market.
Right.
In the U.S.,
Similar story of specific strengths. The Chicago BAI 50, that had a big gain too, a plus 11.1% week over week. Rates rising, particularly to Europe and Brazil from there. So again, it highlights these quite complex demand and capacity shifts happening globally, not just a simple up or down trend.
okay, so that's the rate environment, very dynamic. But rates don't exist in isolation. Let's talk about fuel, jet fuel costs. What's the latest with oil prices?
Always a huge factor. Well, this week, oil futures actually dipped a bit. WTI was down about 2.5%, settling near $64 a barrel. Brent fell around 2.2% to sort of $67, $68. Markets seem to be expecting OPEC Plus might increase output.
So potentially some relief on fuel costs for operators.
Potentially, yeah. Lower jet fuel prices help their bottom line, obviously.
Yeah.
But fuel cost is only one side of the coin. The other is capacity, how much space is actually available to fly goods.
And we got some interesting, maybe slightly worrying signals on that front from manufacturing.
We did. U.S. factory orders overall fell 1.3% in July, but the really eye-catching number within that was commercial aircraft bookings. They plunged 32.7%.
32.7%. Wow. That's huge. What does that signal for air freight capacity moving forward?
It's a definite watch out. Fewer orders for new passenger planes eventually means less belly cargo capacity, the freight space in the hold of those passenger flights. That belly space is a massive part of the global air cargo network. So fewer new planes ordered today could mean tighter capacity and potentially higher prices a few years down the road.
That's a really important long-term consideration for anyone managing supply chains. Okay, so we have shifting rates, volatile oil, potential future capacity constraints. How does the broader macro picture, like trade policy, fit in?
It all weaves together, doesn't it? You saw tech stocks doing well, pushing up the S&P 500 and Nasdaq, suggesting some optimism, but then energy stocks fell because of those lower oil prices. Shows how interconnected yet different sectors react. And then you layer on things like trade policy, the talk of higher U.S. tariffs on goods from India, for example.
Yeah.
That kind of thing adds uncertainty.
How do tariffs directly impact air freight?
Well, they can reroute trade flows completely. Suddenly, a particular lane might become too expensive, so shippers look for alternatives. That could mean different routes, different airports, maybe even shifting between air and ocean freight if possible. It directly reshapes demand patterns and puts pressure on capacity in different places. So yeah, energy, manufacturing, trade policy, they all directly feed into the air freight market and that broader economic feeling. It's like you said, a complex web.
So recapping, we've seen these really specific shifts in air cargo rates, felt the impact of oil price swings, and flagged those warning signs about future capacity from aircraft orders. It's definitely all interconnected.
Absolutely. And it makes you think, doesn't it? With all these moving parts, the regional demand shifts, the oil price uncertainty, the trade tensions, that potential squeeze on belly capacity, what are the sort of unexpected knock-on effects we might see in global supply chains or even the wider market in the next few months? That's the big question, I think.